Good day, viewers. This is Michael Olubenga, the training consultant and the economic analyst, Adonai Associates. Today, we are going to be talking about account receivable policy in an organization. It is otherwise known as a debtor policy in an organization. We must realize that we cannot talk about account receivable without talking about credit sales. Credit sales brings about the word account receivable. For example, if you sell any product outside on credit, definitely you have an outstanding payment outside. That money yet to be paid into your accounts as a result of credit sales is known as account receivable. This item will be recorded in the asset side of the balance sheet. And when you record anything in the asset side of the balance sheet, it means it's what you have. Although you have not yet collected the money, it's more or less referred to as a cash equivalent, which you are expected to collect in the nearest future. When you look at account receivable policy, we look at it that it comes about as a result of a credit sale. Because when you sell anything outside on credit, definitely you have a pending payment outside, which we will refer to as account receivable. If you carry too much account receivable on your book, the side effect of it is that it means you are carrying a lot of credits on your book. That is the item yet to be paid. If you keep on doing this a lot, it will become extremely difficult for you to see enough cash to run your organization. That's why we come about with this topic. How do you manage your account receivable book? That is, how do you manage your debtors? We know that in Nigeria, in a countrywide today, it is extremely difficult to run any business without giving credit. If not, or that customer will definitely move to another place where they can offer them credit sales. So since it's become imperative that you must give out credit, then you must also sit down and think about how do you manage your debtors? How do you manage your account receivable such that you will not be carrying too much of it that will not enable you to have enough cash to be able to run your business. So that is exactly what we are talking about in this very class. Like I said, account receivable is normally recorded as your asset side in the balance sheet. It is what belongs to you, but you have not yet collected. It's an outstanding payment you have not yet collected. So, and that is why we are in this class. How do you manage that your outstanding payment is not always growing to the extent that you may not have enough cash to run your organization effectively? What are those things that you are going to do to make sure that you're able to manage your cash flow very well? One, as a businessman, like we said, for you to be successful in your business, you must be able to manage your cash very well. And the customer you're actually selling credits onto, you must also know how to manage them. You must be able to understand them very well, know their financial capacity, and manage them according to their financial capacity. Now, the question now is that how do you manage your account receivable in such a way that it will not affect your day-to-day running of a business? Number one, you must make sure that when you supply any product on credit, you must accompany it immediately with the invoice. What is invoice? Invoice is like a receipt whereby you outline the quantity you send to your customer and the price, probably the grace period that that person will have to pay the money back. Because this is a kind of awareness you are giving to your customer that the product I'm sending to you, the payment is not indefinite. You have to start planning for the payment within the stipulated period. By so doing, you will know that within so period of time, you need to pay your money back. That is number one, to be able to control your account receivable balance. What is the second thing that you look into? You have to also ensure that you make the payment easy for them. Make the payment easy for them. If you supply any product on credit, you should know that payment capacity of every customer are not the same. You have to assess them, assess their paying capacity, and then grade them according to the capacity of payment so that you can be able to know when customer A will be able to pay, when customer B will be able to pay, when customer C will be able to pay. By that time, you can be able to assess your cash flow status and be able to plan ahead. But if you don't do all this, if you don't do all this planning, you just be carrying unnecessary account receivable in your book, and before you know, to get require cash to continue running your business will become extremely difficult. Also, what we are saying in essence is that you must try as much as possible to study your customer and then put them at a grade whereby you can be able to know when this one will be able to pay your cash back. That's the second aspect of managing your account receivable. Then, thirdly, you must also study the slow paying account. Look at those accounts, look at those customers. Who are those people that normally pay late among them? So that's why there's what we call aging account receivable. You have to go, categorize them into a category. That's group A. This one pay around November, this one pay around January, this one pay around June. You should be able to know how fast individuals are able to pay. That's what we call aging account receivable. You know those people that normally pay late. So you are going to categorize them according to their payment capacity. So when you're able to do all these things successfully, you can be able to plan ahead and know the capacity of each customer so that at the end of the day, you can be able to get your money on time. So the reason why we are doing this is to make sure that you don't, experience what we call bankruptcy. Because if you just supply any product on credit without assessing the credit history of your customer, before you know, he might not be able to pay the money back, and before you can be able to understand what is going on, you will be experiencing what we call bankruptcy, whereby you will not be able to pay your money back. And the end result of everything will be bad debt. And if you are carrying a lot of bad debt on your account, it's not speaking well for your accounting statement. So for you to avoid all these things, you must keep all these things in mind and then get a good, better way of running your business. So we are going to be, wrapping up today. In our next slide, we are going to be talking about account payable. But let us have a recap. What do we mean by account receivable? Account receivable is an outstanding payment you are expecting as a result of credit sales, money that you are expecting from your customer that he has not yet paid after supplying product to him on credit. Like I said, you are going to record it in the asset side of your balance sheet because it's your money. It's a money that is not yet money, but cash equivalent that you are expecting. That is just the summary of the meaning of account receivable. Finally, we'll be wrapping up here. My name is Michael Olugbenga, the training consultant and the economic analyst at Adoni Associate. If you want to know more about us and about our training schedule, you can log on to Adoni Associates. www.adoniassociate.com. From there, you can be able to see some of our blog posts and some of our training schedule and other inspiring write-up that you can actually benefit from. Thank you very much.